You're good, Ken.
Well, hello, everybody. This is Ken Winans and Stephanie Larson, and you're probably wondering, why do we have a split screen? Well, many of you probably know I have relocated to Las Vegas. The company's actual headquarters is now in Las Vegas, and Stephanie is in our office in Novato, California. So, anyway, hello, everyone, and I hope you're having a good summer. Stephanie, anything
We
you want to say?
we will do videos as we traditionally have been doing once we're in the offices together. But in the meantime, we have resoundingly heard from our clients that they want the videos to continue. So this is the medium, unfortunately, that we need to use until we're in the same office together. So
There you go. And I will be back in the fall. Certainly, I'd love to see all of the the Northern California clients. I'm actually heading to Los Angeles tomorrow through Friday to see many of our clients that are down in that area. And obviously, we have a growing clientele in the Las Vegas area. So, the idea of this move, it was to be able to expand our staff coverage to do more face-to-face meetings with people. So I think you'll all find it a chance. And then also, anytime any of you want to come out to Vegas, especially when the summer heat's over, you're welcome to come out and I will gladly show you around. So I've already had that offer taken up quite a few times. And Steph, why don't you go ahead and get started? What do you, we just finished up the quarter. What did you see going up?
well, I think for the quarter end, everyone should have the reports first of all. If you haven't, please reach out and let us know. There was no issues with reporting. My commentary will be out by the end of the week. It's a little tardy this time. We've had a really busy start to the quarter for whatever reason. The second quarter was a little more subdued compared to the first, but the first was actually very aggressive in performance, so we're not surprised. But it was still a very strong and positive quarter, which was great. We're very happy with the way the portfolios have shaped up this year so far. As we've mentioned in previous videos, we've taken profits off the table. We've definitely done some aggressive reallocating, and we're going to put some new names actually in the portfolio this week. Most likely tomorrow, actually. So we've been canvassing the market and looking for the names that we want to find and making sure that we're happy with everything in it, and we really are. So, Ken, anything you want to touch on?
I would just bring up as well. This quarter is always a funny quarter because we're trying to get reports out right in the middle of a major holiday. So it can be a bit problematic. But we are in the middle of earnings season,
Mhm.
and so right now between today the Federal Reserve gave testimony about the future of interest rates, where they're
Mhm.
going. We have most companies have not yet reported their mid-year earnings yet, and
Mhm.
more important, guidance for the remainder of this year and going into 2025. To us, that's critically important to
Mhm.
see which companies, again, I've brought up many, many times, which companies have figured out how to deal with inflation and which companies have not. And it's
Mhm.
very clear there's winners and losers. While I'm on that, whether or not you folks have looked at them in a while, please go and read the Forbes articles I've done this year. Every now and then I surprise myself that my research is pretty much on target, and I go back and look at what I've started the year with. It's on target right now. Also, I'm still doing ABC radio interviews weekly. Usually it's on a Thursday, but there's podcasts. If you go to the Winans Investments website, there's a button for all ABC radio interviews. I would encourage you to listen to the last couple of them because I've talked about this quite a bit.
Mhm.
Steph, what are some of the other topics you're hearing about?
Um, okay, so one of the things on the fixed income side of the portfolios, um, you will have noticed there have been a lot of calls in them. They've actually slowed down. I think I only have one more set for the next few weeks to be called. Besides that, I think actually we're in like the double digits. That's a lot for a year. And Ken and I have gone back and forth as to the reason why we think companies are doing it, but it is happening. So replenishing the paper in the portfolios has taken a lot of time. I'm definitely trying to still squeeze as much yield out of the market as I can possibly get. I'm not having to extend maturities any further. We're still keeping really in the 3 to 5 year. I think I might have added 1 6 year in there, but not a lot, which is great. So we're keeping duration really low. Yield is still pretty good in the sevens, and we're really going to keep humming that along. But it has been a lot of work. There's been a lot of calls over the last really 6 months, to be honest.
I would add to that that a big part of it is when you have a stock market that is hitting new highs, a lot of companies issue stock
Mhm.
and they pay down their debts.
Yep.
Probably every CFO on the planet is saying it's time to pay down our balance sheets.
Yeah. I have a
Um,
sneaky feeling that's what it is.
yeah,
Yeah, I would
I'm
agree.
pretty sure too. And just so you all know, Stephanie and I talk every morning, early every morning.
Hmm.
We usually are seeing what's going on in Europe, and then it rolls. It's like a wave. It goes around the world, and we have to keep a tabs of it. Let me just talk about a couple of big picture items because obviously we get asked a lot of questions. One, I'm asked all the time, what is the difference this time in the inflation cycle versus the past? It's quite frankly the strength of the dollar. The dollar is, I mean, if anybody's been following, anybody planning a vacation to Japan, you might find that your dollar goes a lot further. Japan's currency, which has usually been very strong, is at a 30-year low.
Hmm.
When there's problems in the world, people come back to the mothership, and it is still the United States.
The
So,
dollar. Yeah.
yeah, the dollar is, and I think the dollar will continue to be strong. That can affect earnings for some companies that are trying to sell products globally, but at this point, it seems to not be a problem. That's number one. Number two is I think that we've accepted the reality that when Stephanie and I first started talking about inflation, I remember telling back, you go back and look at it in some of the past recordings, I said inflation runs 6 to 8 years. That's the cycle for inflation within the United States. I never think it's different this time. It might be different flavors, but it's largely determined by the same elements. So the point being said, if I'm right, that means we're only halfway to 60% through this thing. Companies have accepted that. They're no longer waiting for the Fed to come and rescue them. They've learned to accept where interest rates are now. And I will stick to my analysis that I do not think the Federal Reserve does not want to be accused of getting in the political fray for the remainder of this year. They purposely try to avoid it. And I do not think the Fed will make any substantial policy changes in interest rates until first quarter next year. Steph, what are your thoughts?
I would agree with that. I was convinced they were going to do at least one cut this year. I'm still not convinced that they're not, but as we are getting into the latter half of the year, the election's only a few months away. It's really hard for them to really do that, to not seem like they're, politicizing themselves or their decisions. Um, I'm not sure. I don't think they will. I think it's going to be next year. But again, I agree with Ken. I don't feel like the companies need that bailout. And the market, again, today hit all-time highs in several indices. So it's not like the market's suffering and this is going to be the saving thing that happens. I do think, though, when they do it, even though it is baked into the cake, I do find that the market's going to have some more juice. I really do. I think it's still going to be seen as a positive thing that the market will respond to. So I think one of the other things that I'm really paying attention to is really the election cycle. Like I'm focused on the Fed. I'm not really concerned about which politician gets elected, but what I'm hearing from our clients on both sides of the aisle is that they're deathly scared if the other party gets elected. And Ken and I have gone back and forth on this many times. It's nothing different than what happened 8 years ago, where everyone said the world was going to end, or 4 years ago when they said the world was going to end. It's just not so. And if it was a one-off, just one client or maybe two clients that had said something, when you start getting into like the 20 range of clients that are bringing this up, I just felt it needed to be touched on today that don't politicize your portfolio. The banking system is not going to crash on us. You know what I mean? Everyone needs to calm down a little bit. The problem is that the rhetoric in the news is so negative and it's so vociferous and it's just vicious stuff that's being said out there. So the problem is it makes everybody scared. We're watching the markets hit all-time highs. We're watching our stocks do and our bonds do very well. We're watching them pay. We're not watching huge defaults. We're having the market tell us what we need to do. We also have our risk mitigation protocols that we absolutely have in place so that if something did change, that we will enact them like we always have. And clients that have been clients of ours now through several cycles will know exactly what we're talking about. And in the meantime, I'm watching the Fed more than I'm watching the politics. Politicians just like to talk. It's not always a lot of action, right? So that's not really going to impact the portfolios per se. And I know Ken has strong feelings on this as well.
Well, I just, you have to look at what industries will do better under certain
Mhm.
policies versus others. And
Agreed.
however I may personally feel about it doesn't matter. It is about, look, if there's an agenda going in one way or the other, Stephanie and I already have our list put together of a change in administration or a change in anything. As I think I saw in 2016, there was a vast change in the stocks that went up, and we pivoted very quickly
Mhm.
into those names that will move in those directions. So
Mhm.
um, our job is to make clients money. That is our mandate, and it's to keep it when things get ugly. And
Mhm.
so we're just simply going to look for the names that will work when whatever world we're given. I
Yes.
would just say this, that the as you all know, I monitor the commodities very, very closely, and it is very interesting to see that a lot of these dislocations that caused by COVID, everybody thinks we're past COVID. I would call it the post-COVID world, but it's not normal. And you're still seeing these wild, wild gyrations in things like copper, lumber, gold, silver. I mean, it is all over the map. So the point is, we're aware that although things are functioning, we're not going back to the thinking that, well, we're magically going back to some pre-COVID existence. I don't think that's going to happen anytime in the near future for a lot of
Yeah.
different reasons. I would also say, too, that to be very careful about having pet stocks, pet industries. I know many people right now, the big theme of AI, the big theme of crypto. Crypto's a good example. Crypto just ended up getting slaughtered over the last 2 months. So you want to be very careful that what goes up in this kind of world can come down very fast. So when you see Stephanie and I taking profits, it's not that we hate a company, but I might be concerned about the valuation.
Mhm.
And I'm actually literally right now looking at valuations out to the end of 2025. And if I'm getting flashing red V's on my screen, that tells me this company's priced for perfection. I would also bring up there will be, not if, but there will be volatility during this earnings season. There
Yeah.
will be some companies that get absolutely mauled because they somehow missed some number, even though it's not a bad number, but they were again priced for perfection.
Mhm.
Steph, would you agree?
We've already seen it. I forget the name that I was thinking about the other day that just absolutely take. I think it was Nike, if I remember correctly. I could be wrong about that, but that absolutely just got pummeled because it missed earnings. So it will happen. The bulk of our names, their earnings come out in the next couple weeks. So we are gonna be, glued to our desks, white knuckling it a little bit on some of them, but it's just part of the cycle. So we're keeping on top of everything. We're happy with what we're in. We're happy with the portfolios and where they are. We definitely are paying attention to everything from politics to the Fed and everything in between, macroeconomic and micro that's happening. And we're just going to stay on top of it. And we're ready to pivot and to move if we have to, aggressively in that case.
Well, we wanted to keep this video short today, so we just wanted to say hi to everybody, and I hope I mean, we will try to do videos every month now that
Yeah.
things have settled down. Moving cross state with a company, a house, and a German Shepherd is not a lot of fun, but I did get it done, thank goodness. So anyway, we really do, again, we thank you for your, being a Winans client, that we're here, we're working hard through it. And please call us or email us with any of your questions. And
Yeah.
we do hope to see you at some point in time going into the fall.
Yes, I would agree.
All right. Take care, everybody.
All right. Thank you guys.